Hello, thank you for tuning in. Today I'm going to teach you about the Dupont identity. This has been one of the most awesome things that has happened in the finance community, I would say. It is one of the few awesome stuff. So what is this Dupont identity? This Dupont identity is basically telling the return on equity, but it tells us what drives the return on equity, what causes the return on equity, so that we as financial managers hopefully one day can make sure we take the right steps to increase our return on equity. So let us write down the formula for return on equity. It is equal to net income, which we get from the income statement. Then we divide that by the total book value of equity, which we get from the balance sheet. Okay, so we're going to multiply basically by 1. Right? It's just going to return us the same thing. Instead of writing 1, let us cleverly write sales divided by sales. That is going to be 1. And let us write total assets divided by total assets. It is still 1. So we have not actually changed this equation. So now let us clearly rearrange certain of this formula so that we recognize certain ratios that we have learned in the previous few videos. So if you rearrange in that specific order, we get the return on equity is equal to So we have net income, now we divide that by sales, okay, then we multiply that by sales divided by total assets, then we finally have total assets divided by total equity. Cool, now let us figure out what ratios do they resemble. So the first one, net income over sales. What is that? That is the net profit margin, right? It is the net profit margin. So let us write that clearly. Net profit margin. So we learned that in our previous few videos, and now it is becoming very useful. So the next thing is the sales divided by the total assets, which gives us the asset turnover ratio. And finally, we have the equity multiplier. Cool. If you remembered all of these ratios, hats off to you. Okay, so we have these ratios. So what are we going to do with them? Right, so this gives us a much better understanding on what is causing the return on equity. So what drives the success of a company and the return on equity. So let me write down the most important line in this video. It is what drives the return on equity. I don't mean like actually driving the car, but let us just understand what is causing the return on equity to move. Okay, it gives us a more understanding of ROE rather than just simple numbers and no understanding or insight from that data. So let us now create two scenario companies, right? Let's create two companies so that we can compare their performances. Okay. So let us draw the lines and let us create two companies, and we will see about what causes their return on equity. In certain companies, it might be a certain ratio, like the equity multiplier be the major cause of increasing the return on equity. So you might want to also increase other parts like your net profit margin by reducing your costs. Okay, so company 1 and company 2. So let's say the net profit goes there and the asset turnover goes there and the equity multiplier goes there, and finally we calculate the return on equity. Cool. Okay, so right now let us write down a ratio of 1 over 10, 2 over 1, and 5 over 1. And those are basically ratios that have been simplified from the big numbers that we get from like net income and sales. I have simplified it to get 1 over 10 and so on. So that gives us 100% return if you convert that into percentage terms. 100% return on equity is not usually seen, but this is just an example, right? You see return on equity maybe 5, 10, 20%, but 100%, right? it is hard to see. But you might be thinking, okay, but this company uses too much leverage, right? This company uses too much leverage. That means they borrow too much, they have too much liabilities, loans, to create this return on equity, right? So now you might be thinking, okay, they're borrowing too much money. Should I be afraid? So we have nothing to compare to. So that's why we're going to compare to another firm. So let us compare to another firm which has 1/5 and 2/1 and about, let's say, about 5:1, the same equity multiplier. So this company has about 200% of return on equity. Okay. So an important thing is that we are comparing here, and I encourage everyone to compare between two different companies to get a more better understanding, or compare themselves with the past performances. Okay, so what is the difference in the company 2? Right, the company 2 only has a difference in their net profit margin. They can sell their products for more money, in cash, right? They can sell their products for more cash money than it cost them to make it. Right, so they have lowered their costs so much so that they are able to be more profitable. So as the role of a financial manager, it is up to you to make sure that you are able to maximize the shareholders' wealth. With this formula, you'll be able to specifically figure out which part of the department is having trouble and start solving that. Is it net profit margin? Then start lowering your costs. If this is asset turnover, then start increasing your sales, right? Equity multiplier. So this is all about the Dupont identity, which helps you to understand the return on equity. If you really like this video, feel free to subscribe and visit our website. And as always, thank you for your time. See you later.